Time to talk personal finance thanks to our partners Forsyth Barr. Housing, it's long been touted as a safe bet for Kiwi investors, but the costs, the risks and the hurdles, well, they've all risen significantly, and all while the house prices are falling. So where does that leave property investors? Will the market ever be the same again? I'm joined by Forsyth Barr Senior Investment Advisor Brad Gordon. Good morning, Brad.
Good morning, Garth.
Hey, lovely to have you here in the studio with us to talk housing. It feels like we never stop talking about housing in New Zealand, but I guess what's changing is exactly that, the picture around costs and pressures and so on. Is it still a relatively sort of safe bet?
Well, it means a lot to all of us, and obviously we have to house our families, and it's important and it provides us some security. But for many people, it's been a wealth creator as well. And for 30 years, they've been right. They've had probably two major tailwinds, and we're now saying one of those tailwinds is no longer with us. Not only that, there's been a lot of costs associated with just owning a house that have gone up. The core components or the key components of our inflation over the last 3 or 4 years, all pretty much directly related to property ownership. So it has changed the game a little bit.
So the tailwind you're talking about there really is what, the sort of the drop in values as well, or is that more the rising cost picture?
Look, we've seen about a 16% drop nationwide since 2021. And some people are saying that might be an opportunity. We're saying it might not be. One of the reasons over the last 30 years we saw, or in effect, house prices are two components go into them. One is your median disposable income, household income, and the other component is the ratio to house prices of that median disposable income. Over 30 years, largely because of falling interest rates, we saw that ratio climb up to a high of 11 times, much higher than anywhere else in the world. Part of that was because there was a lack of supply as well.
But just the ability to leverage it as well.
Yeah. And the ability to leverage it. But all those, those key components are now pretty much exhausted. We still have a very high price to income ratio on houses, even now after a 16% pullback. So all we can really rely on is that median household income to rise steadily, which averages between 3 and 4% per annum.
And it's probably just not going to get there in time to sort of catch that up. So what do people need to be considering then? Are they looking at the rental market and saying, gosh, let's see what that's telling us and what sort of yields and returns we're likely to expect there, and getting some clues there?
Yeah, well, I think you just stay diversified. Rental property may be one way, and there will be pockets of opportunity if you do your homework and extract yield. But what we're saying is that capital growth component, which people relied on because largely rental property is a sort of break-even income story, they've relied on capital growth. We're questioning the extent of that capital growth going forward. Questioning
it in the medium term, or are you saying this is it, the tide's gone out forever?
I think that ratio, because of the median household income to price ratio is still so high, we don't see it rising any further. Therefore, you're only really relying on increases in median household income to drive house price growth.
So you need to look at diversifying your portfolio completely then, maybe even away from some of that housing?
Well, bringing that back, you can see a strong case for house price growth being around 3 to 4% per annum. Over the prior 30 years, it averaged about 6.5%. That's probably not going to happen again.
And demographics don't play into this anything at all?
Well, that's the other side of thing. The equation is we've seen a supply response. So all this rezoning and that's still taking place, we're seeing a major supply response. So again, one of the drivers was a lack of supply. That's no longer an issue either.
All worth talking about. Thank you very much for your time this morning, Brad Gordon, Forsyth Barr Senior Investment Advisor. Thanks to our partners, Forsyth Barr.